Hello and welcome to another episode of Spy Trader Now. Today is May 27th, 2023, and our model portfolio is up 6.21% year to date, which, by the way, we're about halfway through the year. And if we continue on with this pace, we are going to be at 12% at the end of the year if we do nothing else and just continue on with the same strategy we've been doing, which pretty much this entire year, all we've been doing is selling cash secured puts. And we've been selling them and not even been exercised because we're so far out of the money that our strikes never get exercised. So it's pretty conservative. And so 12%, if we continue this rate at the end of the year, will certainly not be a bad year for a return on investment. What we do here at Spy Trader Now is we try to beat the returns of the S&P 500 buy and hold investor. And the SPY buy and hold investor currently, their portfolio is up 9.69% year to date. So we have some work cut out for us to beat that return. Here are some past results for Spy Trader Now. You can see that in 2022, we were up 21% compared to the SPY buy and hold investor. By the way, when I say SPY, that's the S&P 500. We purchased the ETF and the symbol is SPY. That's why our handle is Spy Trader Now. So the SPY buy and hold investor in 2022 lost 19%. 2021, we're up 78% compared to 28%. And in 2020, we actually doubled the portfolio, 100% return compared to only 15%. If you want to see how I do this, hit that subscribe button, ring that bell, and smash that like button down. Thank you. Spy Trader Now, we buy, sell, and trade the S&P 500. This is a one-year chart of the S&P 500. We're going to go through the charts in much greater detail later on in the presentation. But on this chart, you can see that I did a cash secured put on 5/23 with an expiration date of 5/26. Well, today is 5/27, so my option expired out of the money yesterday because the S&P SPY closed at 420 and our strike price was at 410. So we expired out of the money. Last week, the S&P 500 gained 0.33% for the week. Here is the trade that I sent out. I sent it out on Tuesday. We did two cash secured puts, 410 strike, 5/26 expiration. I got 79-cent premium for that, which is about a 17% annualized return on investment. And that was about 81% of the portfolio was tied up for that cash secured put strike sent out at 12:37 p.m. Pacific Standard Time. If you want to receive my alerts, go ahead and head over to spytradernow.com. There'll be a link down below and you can sign up and receive my alerts as I send them out. Here are all the trades I made for the model portfolio for calendar year 2023. If you want to see all my trades going back for the past 3 years, head over to spytradernow.com and you can research all of my trades. Here is the equity curve for the model portfolio. And you can see this is a year-to-date portfolio equity curve, and it's nice and steady up. Here is the equity curve for the SPY buy and hold investor. You can see how they have gone up and down and up again. Right here is the equity curves of both portfolios on the same graph so that you can do a comparison analysis. We always compare ourselves against the benchmark of the S&P 500 buy and hold investor. Currently, they are above our portfolio by 3.5%. So I've got some work to do ahead of me to beat that return. Here is the head of the Fed chair. His name is Jerome Powell. And the last interest rate hike was done on May 3rd, 2023, 25 basis points. The next announcement for a Fed rate hike, if we're going to have one, will be on June 14th. Right now, I think it's a 50-50 probability of whether we're going to have a rate hike or not. Here's a new slide that I'm introducing into the presentation. This is what's called the presidential election cycle theory. And what it states is the year after the election, the S&P 500 is normally up 6.7%. The second year, 5.8%. The third year, up 16.3%. and the fourth year 16.7. So the key takeaways here is that the worst year is the second year after the election, and the best year is the third year. Well, what year are we in now, Ken? Well, President Biden was elected in 2020. So in 2021 was the year after the election. So we're in year 3, the third year. So there is a historical average of 16.3% is the gain in the current year for the S&P 500. Well, where do we stand right now? Well, the buy and hold investor currently stands up 9.69% year to date. And the historical average is for the third year of the election to be up 16%, meaning that there's still a lot of bullish time remaining in this calendar year. So this is something that we want to be aware of in case we want to also sway our decision one way or the other. So this is considered a very bullish year, according to presidential election cycle theory. Now we're looking at things from a bond market outlook. The bond market is saying stay out of the stock market because we have an inverted yield curve and we have rising interest rates. Should we be in or out of the market? We should be out of the market, according to the bond market. And the bond market is somebody you want to listen to because they are 4 times the size of the stock market. You can get this information at bankrate.com. There'll be a link down below if you want to explore this on your own. Now we are going to look at the stock market from a valuation standpoint. And currently, according to current market valuation CMV, here's the link. It'll be down below in the description. We are overvalued by 44% above the market average. This is going according to the PE ratio. The average is 20. We're at 29.1. That puts you on the standard deviation chart at 1.1. So it's tough to make all your financial decisions based off of this information because the market can continue to go up even though you are overvalued. So we just want to take all this information that I'm giving you with a grain of salt. Just be aware this is where we currently reside. Here is the Fear and Greed Index. And here is our best friend on Wall Street, Warren Buffett. The greed index is at 68. Last week it was at 68. So we're kind of staying steady with 68% on the market. So we are not at extreme greed. And of course, be fearful when others are greedy and be greedy when others are fearful. And now we're going to look at things from a seasonality outlook. This is a seasonality graph, S&P 500 going back 20 years. We are currently in the month of May, although there's not much left. The month of May is going to end next week. I think it's ending on Wednesday. Now, there's a 74% probability we're going to close higher than when we opened. We are currently, for the month of May, up 0.98% for the month. We've already achieved this goal according to a seasonality graph. Now we're looking at a chart 20 years, monthly, S&P 500. Nice bull run since 2009. Then we had a downward trading channel and we broke out above it. We are bullish as long as we stay above this support line. MACD just about ready to cross above the signal line. Slow stochastics traveling north above its signal line. All bullish. Intermediate term outlook, weekly, 5 years for the S&P 500. We were in this channel right here and we are just broken up above it. We have another resistance line at approximately 425. Right at this candle, this wick of this candle right here. Once we break that, then the next resistance jumps all the way up to about 453, which is this one, and then we come to the all-time highs. Here's a 1-year chart, daily candlesticks, S&P 500. You can see that we were in this trading channel. We broke out above it, came below to about the midway mark, and then bounced and went up above it. I think we're going to stay above this line for some time now. The MACD has also broken up above it. And you see the way the MACD has a positive slope to it here? That's a bullish condition for equities for the S&P 500. Slow stochastics is above its signal line. All of these things breaking out above range. MACD positive above signal line. Slow stochastics positive above signal line. Everything suggests we are going to move higher over the next week in the short term. This is a new graph that I wanted to introduce and show you. This is a ratio graph of the RSP compared to SPY. Well, what is RSP, Ken? That is the equal weighted S&P 500 compared to the normally weighted S&P 500. Well, what's the difference, Ken? The difference is that in the normally weighted S&P 500, the way the index works is it gives a greater weighting to large cap stocks. So the equities that have large mega cap positions, as an example, they have a larger percentage of the S&P 500 compared to an equal weighting of all stocks. So when you see, and by the way that this graph works is that the ratio chart is here in red and black. The S&P 500 is here in blue. Well, when you see the ratio graph traveling south, that means that fewer stocks are participating if there's a rally in the S&P 500, which there is. There's a current rally in the S&P 500. But when you see the RSP going down compared to the S&P 500, then you know that what's carrying the S&P 500 is those large weighted mega cap stocks. Now, where we are at now on the MACD at this level right here, negative 0.0059, we've only been at that level 2 times in the past 20 years. And where you see this blue dotted vertical line here and here, that is where the MACD crossed above its signal line. So it bottomed and crossed above it. We're not there yet. You can see the MACD is still below its signal line and traveling south. But when we bottom and cross above it, that's the blue line. And if you look where the S&P 500 made its advances after that blue line, it was very close to the bottom of when the advance started. So we could be there after this MACD bottoms and goes above its signal line on this weekly chart. So we're going to be keeping this graph on for our weekly presentation because we want to monitor this, and because once we reach that condition, we could theoretically be entering into a new bull market, meaning that we can take on more risk and get those gains as a result of that, as long as we are going to have this nice bull run ahead of us. So we want to be monitoring that. All right, here is a list of the top 10 holdings for the S&P 500. You can see the companies here and their symbols here and their percentage of weighting on the S&P 500. But basically, these 10 companies out of 500 equates to about 28% of the total of the S&P 500. So you can see how a few companies have a major impact on the performance of how the index does as a whole. All right, here is a 6-month chart with daily candlesticks for the S&P 500, and we were in this trading channel and we broke out above it. I think we're going to stay above it now. That's my prediction of how we're going to fare over the short term. Over the long term, I don't know, but for right now, I don't see this coming back anytime soon. I could be wrong, and on Tuesday when the market opens, it could open up below here, but I'm just giving you my prediction. And even though it's a prediction, doesn't mean it's going to absolutely hold true, but that's what I'm saying I think is going to happen. All right, here is the VIX, or the Volatility Index, or the Fear Index. We've been stuck in this trading range for some time now, a few months. We're still stuck in it. The MACD has topped and is traveling or coming down towards its signal line. Same with the slow stochastics. So with the fear coming down, the market, because it works inversely to the VIX, The market, the S&P 500, is either going to travel sideways to north in the short term if the VIX continues to travel down from here. Now we're looking at a one-year chart for the S&P 500 on the Think or Swim platform. In here, I have standard deviations, the +1, +2, -1, -2. 67% of all trading takes place between the +1 and -1, and 95 between the +2 and -2. We are right now butting our heads up against the +1 standard deviation. The last time we did that, we just kind of broke out above it before traveling back south. And over here, we didn't even reach the +1 standard deviation. So what we don't know is if we're going to break out above it, how much time we're going to spend above it, or if we're just going to bounce off of it and travel down from here. So, but that's where we currently reside. Now we're looking at the same chart, but instead of going back 1 year, we're only going back for 3 months. So with 3 months of data showing, you can see the bars a little bit more clearly. And on this graph, we are just above the midpoint of the standard deviations. So the market can really go in any direction. It has room to go farther up from here and stay in this range and kind of bounce around, which is what I think it's going to do over the next week or two. On Monday, May 29th, 2023, the market will be closed as the market will be observing Memorial Day. So the next trading day is Tuesday, the 30th. I have just given you a ton of information throughout this presentation. Now comes the critical thinking. What are we going to do with that information? Here is my market summation as of May 27th, 2023. The market is showing that it just broke above a trading range, but will it stay there? I think it will. That's my expectation. So I want to participate by selling another cash secured put trade. So on Tuesday, when the market opens 5:30, my expectation, as long as the market doesn't have a black swan event and it looks like the market it does today on Saturday, I'm going to sell to open 2 cash secured puts with a 6/2/23 expiration, 410 strike, 83 cents is how much it's currently yielding. That's about a 25% return on investment annualized. By the way, if you want to get the same cash secured put calculator that I use for free, just head over to spytradernow.com and you can download it. So this is how I plan on playing the market for the next week. And then I'll reevaluate next weekend and do the same thing. But that is my take on the market. I hope you have gotten some valuable information out of this video. If you have not done so already, hit that subscribe button, ring that bell to be notified when I post a new video. Help me promote this video by smashing that like button down. I wish you good trading.